Assalamualaikum and a very good morning, everybody. How are you guys during the PKP period? Okay, I hope all of you please stay at home and make sure that you eat well, sleep well, as well as arranging your time for this challenging period. Okay, for Audit 589, the first auditing paper, as you know that we have learned the first two topics, which is covering the introduction to auditing, where you learn about why do we need to perform audit in organization, and then we continue with audit regulation, where you learn about MIA by law, as well as Companies Act 2016. Now, all the while we have been doing we have been studying external audit. You see yourself as external auditor. So by seeing yourself as an external auditor, what you're doing is financial statements audit. So today what we're going to do is to look at the scope of financial statement audit itself. Now, the main point here is to know what will be the scope and the management assertions and the objective, which we will cover in the next slide. Now, let us look at the scope of financial statement audit. But before that, just to be clear, you need to understand what will be the objective and responsibilities for the audit. Okay, remember in the previous class, we know that the responsibility to prepare the financial statement lies on the directors of the company. That means to the accountants and the accounts department who are responsible to that. What we have to do is just to verify whether the accounts being prepared by them are actually present the true and fair view of the whole transaction which have occurred throughout the year. Now, looking at the financial statement, we will divide the financial statement into cycles. And then we need to know the management assertion. What is management assertion? We will discuss later. And then the general objective for the classes of transactions as well as the accounts. And we also need to know what will be the audit objectives that we want to undertake for each class of transactions and accounts. Now, these are the cycles of financial statements. There are 5 cycles. Basically, there are sales and collection cycles, acquisition and payment, payroll and personnel, inventory and warehousing, as well as capital acquisition and repayment cycles. All these cycles will be covered in topic in week 8 and 9, okay, where we will discuss each cycles individually. Now, come to the crux of the topics, which is management assertions. Management assertion, in a simple way, is saying that what is it that management is trying to convince us or assert to us? What is it that these accounts wants to achieve? That's why it says here that management is responsible for ensuring that financial statements give true and fair view in accordance with the applicable financial reporting framework. Okay, as all the while we have been looking at the financial statement, we look at the financial statement and we see that there are many items in there that make up a financial statement. Okay, let's say we have an assets. So, what is it that management need to assert about these assets? For example, the management must make sure that the amount reflected as assets in the financial statements, they really exist or have been completed in detail. So that's why, all these assertions, all these elements of the financial statement need to be asserted by the management. Okay, maybe by looking at other slides, you will have this aspect much clearer. Okay, these are the 7 management assertions that you need to understand, which is existence, occurrence, rights and obligations, completeness, valuation or allocation, measurement, presentation and disclosure, where we will discuss this each of the items later. Okay, now let us look at the first one, which is existence. Existence here talk about whether the assets and liabilities exist at a given time. Let's say your financial statement ended at 31st December 2019, last year. So if the management asserts that inventory shown on the balance sheet is 20,000, they have to prove that at that particular time, the inventory actually physically exists and available for sale. So as auditor, we need to check and to verify whether what they have claimed, what they have asserted in the financial statement actually true. So by doing our sample and by actually checking certain items, documentation for example, that's what we do. Another way is actually doing the physical inventory count, which we'll usually do at the year end. Okay, come to the second management assertion is rights and obligations. Basically, it says that the assets are rights of the entity and liabilities are its obligation. That means if they have the assets, it belongs to them, and liabilities are the obligation that they need to fulfill. Okay, I'll give you an example here. Management asserts that the entity has legal rights of ownership to the inventory shown in the balance sheet. That means the company owns the inventory. At the same time, amount capitalized for leases reflect assertions that the entity has the rights to lease property, and at the same time or correspondingly, lease liability represents obligation of the entity. That means we have the assets, we can use it, but at the same time, we are saying that we have lease liability, which is obligation to the entity. Okay, the third one is occurrence. A transaction or event has taken place. Management asserts that revenues reported in the income statement represent valid sales that occurred during the period. We are saying that whatever revenue that we have recorded in the income statement is actually a valid sales. It has happened. So let's say if we go for audit, how do we verify this? We have to look at the documentation, copy of the sales. Maybe to verify whether the sales actually exist. Another way is looking at who actually ordered the sales. So there will be other supporting documents as well. Okay, come to the fourth one is completeness. Accounts and transactions that should be included are included. Thus, the financial statements are complete. So, in preparing the accounts, we're not just going to look at the occurrence or existence of the transactions. We must make sure that it will be included completely in the accounts as well. So again, it is a responsibility of the management to make sure that all the accounts have been recorded completely. Now come to the next one is valuation. Under valuation, basically we are saying that the amount that they have recorded, let's say as assets or liabilities, are recorded at appropriate carrying value. If it is an inventory, of course, at the lowest cost or market value on the balance sheet, as what you have learned in your file paper. In terms of measurement, we need to allocate the revenue and expenses item in the proper accounting period. Again, this goes back to your accrual accounting, where only those transactions recorded throughout the year or happened throughout the year will be included in the financial statement. Come to the next one, the last one, on presentation and disclosure assertion. We want to make sure that the amounts shown in the financial statements are properly presented and disclosed. For example, if the management asserts that the portion of long-term debt shown as current liability will mature in the current year, so we need to state this in the notes to the accounts in the financial statement. Okay, who need to set the audit objective? Of course, in an audit firm, for instance, the senior manager or the assistant manager will actually discuss with the seniors or the assistant as well as a junior what would be the audit objectives that we want to use. There are two types, specific or general transaction related to the audit objective, for example the sales or sales return, or it could be specific or general balance related audit objectives, could be account receivables or account payable. Okay, now we go to the transaction related audit objectives. Again, these are the assertions that we need to satisfy: existence, completeness, accuracy, classification, timing and posting, and summarization. But when it comes to balance, we have more assertions that we need to satisfy, which is like cut off, detailed tie-in, realizable value, rights and obligation, presentation and disclosures. Okay, you don't have to worry at this stage, because when we discuss topics related to each cycle, we will see these subtopics clearly. Okay, how do we meet these audit objectives? Again, as I mentioned earlier, in an audit team, the engagement team will discuss among them how do we approach the audit. Most of the time, audit firm will have their own manual. They have a specific way on how to do the audit. So the first stage would be plan and design an audit approach. Again, why is this important? Because we need to understand the client's business strategy. And then we're going to perform the test of control and substantive test of transactions. Not to be worried about the terms, we will later discuss this. And then we have analytical procedures and tests of details of balances. Then only we can complete the audit. And lastly, our product will be an audit report. Okay, later on in sampling, we will learn about how can we get this audit evidence to actually satisfy ourselves. Okay, just now we have mentioned test of control and as well as substantive tests. Basically, test of control is for us to test the effectiveness of the control. Okay, one example is, let's say if we look at the documentation, we are not so much worried, when it comes to test of control, we are not so much worried about the amount, but we are worried about the procedures. Who will be preparing this? Who will verify? Who will check the documentation? So let's say if we have segregation of duty in performing the completing the documentation, that means that they have a good internal control system in the company. But when we talk about substantive test of transactions, we are more concerned about the monetary value of the transactions. That means if you take one payment voucher, you will recalculate to see whether the amount stated in the payment voucher is the same as what stated in the invoices. Okay, we have analytical procedures as well as tests of details balances. Now, let us look at what do we mean by analytical procedures. Is simply when we compare last year's balance to this year's balance to see whether there is any fluctuation, huge fluctuation or not. Because let's say last year we have account receivable of 10,000, but this year we have almost double. So there must be a reason behind it, and we need to discuss with the manager. Again, test of details of balances, as the name states as well, we need to test for the monetary misstatements in the balances. So looking at the balances to see whether there's any monetary misstatement. So these are the relationship. You can look at management assertion, and then we start to develop all the objectives based on the management assertions, then all the procedures, and then only we can actually develop all the evidence to support the management assertion. Okay, you don't have to worry about this flow, because we will discuss this in the following topics, each of the items mentioned in this slide. Okay, I think that's all for the first subtopic in topic 3. Please do your revisions, and we shall discuss in our tutorial in our e-meeting. Please jot down any questions or any query that you're not sure of. You can WhatsApp me, or you can actually call me, as well as we can discuss through Google Meeting. Okay, Assalamualaikum.